Good morning everyone and welcome back to Learning with Tia. In this video we're going to be focusing on the responsibilities and the difference in the responsibilities between management and the auditor when it comes to the auditing process. So let's get started. Now, in order to essentially summarize the situation, and we will talk about this in more detail throughout the video, but as a summary, and we've spoken about this before, management and the directors of a firm are essentially responsible for the preparation of the financial report. So they are responsible to prepare the information as well as the numbers that go within the financial report that we look at. The auditor's responsibility is essentially to come in and check that information. Now, we are going to talk about this in more detail, but that's essentially a summary of the distinction in those responsibilities. In order to delve into the responsibilities of an auditor, it's really important that we refer to the auditing standards, in particular ASA 200. Now, before I go further, it's really important for me to highlight what this dot 3 or point 3 means following the reference of ASA 200. For future reference, just remember this. Whenever we refer to an auditing standard, we first note down what the auditing standard number is, and then we follow it with the paragraph reference. So when at the moment you see ASA 200.3, the way that you read that is it's ASA 200 paragraph 3. And that's why you see that excerpt on this particular slide. So let's move on. What is the audit? So what is the purpose of an audit? The paragraph 3 goes on to say that the purpose of an audit is to enhance the degree of confidence of intended users in the financial report. Now, firstly, what are we talking about when we say financial report? Remember this, and we have mentioned this before, but the financial report includes the financial statements, which are all the numbers. We've got the income statement, the balance sheet, the cash flow statement, and the statement of changes in equity. But it also refers to the notes. It also refers to the written disclosures within the financial report. So just be mindful that when we audit the financial report, we are auditing both the numbers as well as the written disclosures. Now, coming back to what that sentence was saying, that says the purpose of an audit is to enhance the degree of confidence of the intended users within that enhance their confidence in the financial report, in the information, the numbers and the notes within the financial report. Now, how do we enhance the degree of confidence of these people? Remember, first of all, when we talk about the intended users, let me highlight it for you. The intended users, we are primarily talking about the shareholders, the current shareholders in the company. Now, how do we enhance their confidence in the information presented? Quite simply, this goes back to the two key characteristics that underlie the value of audit. And those two characteristics were the fact that we are, number one, an independent practitioner. We are independent. We are not related to, associated with, nor influenced by the client, the information, or how it was prepared. So because there's no link, we have this independence, we have the ability to exercise objective thought. Now that is one way which we enhance the degree of confidence of these people, because we, the auditors who are checking the information, we are not linked to, associated with, or related to how that information was prepared in the first place, or the people who prepared it. So independence is the absolute the key foundation that adds value to the service of auditing that we offer. The second characteristic that underlies the value of auditing is the fact that we are experts, right? We have expert knowledge and skill, and we know what we're doing. We know what to look for. We know how to carry out the audit process and to check the information within this report. So we enhance the degree of confidence of the intended users enhance their degree of confidence within the financial report by being an independent expert. By checking that information and providing an opinion or a conclusion, we are essentially increasing the reliability and credibility of this information. And that's why the following sentence goes on to say, this is achieved by an expression of an opinion by the auditor. Remember, that's the audit opinion contained within the audit report on whether the financial report is prepared in all material respects, and I'll come back to that, in accordance with an applicable financial reporting framework. Remember, that is the AASBs. Okay, so that is the criteria that we used, in determining whether the financial report was indeed true and fair or not. And we express our conclusion in an opinion, an audit opinion within the financial report. Now, when it comes to this word material, I'll come back to that in the next couple of slides. So essentially, the purpose of an audit is to enhance a degree of confidence of the people who wish to rely on the information within that report. We do so by being independent experts and expressing an opinion on whether that the information in the financial report, having evaluated it against the criteria, is indeed, I'll just write this down, true and fair or not. Okay, that's a question mark. Now, to form a judgment or to form a conclusion on the financial report, we must look behind the financial report and we must look at the accounting data, right? So it's really, really important in order to provide a quality audit and to do a comprehensive job, we must know the accounting standards. We must have a very good understanding of what the rules are, what the guidance is, how the accounting had to be performed. It's only if we have that understanding that we are able essentially to actually check that information and reach a conclusion. That is why here I've written there is a close relationship between accounting and auditing. Why? Well, we're essentially auditing the accounting information. Now, when it comes to the financial report, both management as well as the auditor have responsibilities. So if you look on the top left, under the heading of accounting, you see it says responsibility of management. That is because it is management's responsibility to actually prepare the accounting information, again, in accordance with the accounting standards, and also to then prepare the financial report in accordance with the appropriate financial reporting framework. Remember, whenever you see that, it's talking about the AASBs. So what's our job as the auditor? What are we responsible for? Well, if you look on the right-hand side, under the heading of auditing, you see responsibility of the auditor. What do? It is our responsibility to come in. We need to perform our testing. We need to gather appropriate evidence, indeed sufficient appropriate audit evidence, and we need to evaluate whether the information that has been prepared by management is indeed true and fair or not. Remember, what does that mean? It means does the information present a true and fair view of the business? Is it a true reflection of what has happened in the business? And has the information been prepared in accordance with the financial reporting framework, in accordance with the AASBs? So really, if you want to summarize the situation, management is responsible for preparing the accounting information and preparing the financial report. We as the auditor, we are responsible for coming in and checking that information. Now we do that by collecting evidence and checking that evidence against the criteria, the accounting standards, to determine if that information is a true and fair reflection of the business. Okay, so our job is to check whether management has told the truth or not. Now we're going to be talking more about this in class regarding some of the key tools that we use in order to check whether management has been truthful or not. But a key term I would like you all to write down in your notes for now, and we'll talk more about this in class, that key term is assertions. Assertions. Okay? We use assertions to determine if management is indeed telling the truth or not. So as I said, we'll focus more on that in class. In order to delve into the responsibilities of the auditor further, we need to refer to paragraph 11. Now remember our referencing, how we reference an auditing standard, and in particular a paragraph. Remember we start off with the ASA reference, which is ASA 200, and we follow it with a point and then the paragraph number. So when I look at this, this is telling me I need to refer to ASA 200, paragraph 11, which is what we are focusing on in this slide. So what does this paragraph tell us? It tells us that the overall objective of the auditor is to obtain reasonable assurance. Remember, that is the level of assurance we provide, reasonable assurance, when we conduct an audit. That is the highest level of assurance. That's different. Remember, we don't have absolute assurance, nor do we provide guaranteed assurance. What we provide is reasonable assurance. There's no such thing as absolute or guaranteed assurance, remember, because we don't test every single transaction. We often take a sample, we test the sample, we collect evidence, and we use that as a basis for our conclusion. We take samples, guys, because in a lot of instances, it's impossible for us to test every single transaction. We've talked about this in a previous video. If you think about very large organizations and think of the millions of transactions they have on a daily basis, it's impractical. We can't do it. We can't test every single thing. So we take a sample, and that is why the highest level of assurance we provide is indeed reasonable assurance. So what do we provide reasonable assurance in relation to? We obtain reasonable assurance about whether the financial report as a whole, that's the statements as well as the notes that accompany them, is free from material misstatement. Now that word is incredibly important, that concept of materiality. So material. Now let me explain to you what that means. When we talk about material information, or in this case, material misstatement, guys, we're talking about significant misstatements, significant information. The concept of materiality or material essentially means important, significant. It's significant or important enough to change the user's decision based on that information. So in the context of material misstatement, what I'm trying to explain to you is when we perform an audit, yes, we are looking for misstatements. Yes, we are looking for issues. But what we are focusing on are material misstatements, material issues. Think about it this way. If we find a particular mistake in the financial report and that mistake is $1, that's not really a material issue. It's an issue, but it's not a material one. So that won't be enough for us to say the financial report is not true and fair. Rather, what we would look at in order to reach that conclusion of the financial report is not true and fair is we look for material misstatements, significant issues that would impact on the user's decision making. So material is the key concept there. Now, I just want to highlight one more thing. Information, or more specifically issues, misstatements, can be deemed to be material, can be deemed to be significant based on their dollar amount. So I'll do this in a different color actually, based on their dollar amount. So for example, if I found a $1 million mistake within the financial report, that would be pretty significant, right? So something can be significant based on its dollar amount, so how much it was in numerical terms or quantitative terms. But you need to also know that information can be deemed to be material, or misstatement can be deemed to be material because of its nature. Okay, so something can be deemed to be significant based off its nature as well. Now, what do I mean by that? Let me give you an example. Fraud. If I found a fraud within a financial report or within a particular company, it doesn't really matter how much the dollar impact of that fraud was. What would be important to me is the fact that there was fraud. By its very nature, that's a big problem, okay? That would be significant, important material. It would impact on my decision making. So essentially what I'm trying to explain is an issue can be deemed to be significant and worthy of bringing to the attention of users because it's a large dollar number. So from a numerical perspective, it's quite significant, but it can also be significant based on its nature, fraud. It could be a fraud of $20, but it's still fraud. My focus isn't on the fact that it's $20. My focus is on the fact that it was fraud. So misstatements, issues can be material, significant based on their amount as well as their nature. So we look at both of those situations. So coming back to our sentence, I know that we keep starting and stopping, but it's quite important to break down these concepts for you. So remember, the objective of an audit is to obtain a reasonable assurance about whether the financial report as a whole is free from material, significant misstatements, significant issues, whether due to fraud or error. Now I'm going to stop again, whether due to fraud or error, but I'll be quite simple here in the way that I explain it, whether due to fraud or error. Now, there is a difference between fraud and error, and the biggest difference between these two concepts is the intention behind them. Often when we talk about error, an error is a mistake. It's an unintentional mistake. Fraud is an intentional act. So what we are talking about here is that we are looking for material misstatements, or we are looking to see if the financial report is free from material misstatements, whether that's due to fraud or error, whether it's due to intentional act or unintentional act. Okay, now both of these can be material misstatements, and they can both result in us providing a conclusion saying that the financial report is not true and fair. Okay, so the intention behind the act isn't actually relevant. The intention, it can be intentional or unintentional, but it can still result in material misstatements. So we actually do look at both. Coming back to our sentence. So it's to obtain reasonable assurance about whether the financial report as a whole is free from material misstatements, whether it's fraud or whether it's error, thereby enabling the auditor to express an opinion. That's our audit opinion, express an opinion on whether the financial report is prepared in all, again, material respects. So we're looking at the key information in accordance with an applicable financial reporting framework, and that is your AASBs and the criteria that we use when we conduct the audit. So the key concepts to take on board is we are looking for material misstatements, okay, material. We don't mind if it's a very, very small issue, but we are looking for the material ones. But remember, a misstatement, an issue can be deemed to be material, can be deemed to be significant based on its number, based on its amount, as well as its nature. Okay, so something might be quite immaterial from a numerical perspective. It might be quite a small number, a dollar impact, but it can still be deemed to be significant because of its nature. But we're looking for the significant issues. Secondly, when we talk about significant issues, it could be because of intentional fraud or unintentional error. Regardless of which it is, it can still be material. Okay, so we look at both of these situations, and as you all know by now, we use the applicable financial reporting framework of the AASBs as our criteria in conducting the audit. Something to be mindful of is that the accounting standards, which are the AASBs and the same criteria that we use when we audit the financial report, those same standards allow accountants with choice. Right? Now, what do I mean? Well, think about the number of different ways that an accountant can perform depreciation on an asset. We have 3 different methods of depreciation. There are many different areas where there are options, different methods, and different areas of judgment that are bestowed onto accountants, right? Now, this is great, and the reason for this is to allow accountants to use their professional judgment, hence the word judgment, in determining, well, what's the best way of accounting for certain situations, given that the context of the business itself. But the problem is, guys, that it's these same choices that can potentially lead to management and the accountants manipulating the choice or using the choice in a way that results in the financial reports being biased, right? Being presented in a way that actually serves the interest of management or the preparers of that information rather than truly representing the reality of the business itself. So keeping this in mind, it's really important that we as auditors, we exercise what's called professional skepticism. Now, what does this mean? Well, the best way to explain professional skepticism and that concept of professional skepticism is that quite simply, it's keeping a questioning mind. What does that mean? We need to exercise or we need to have a questioning mind, and we need to be thorough when we investigate all the evidence that we are presented with. Essentially, it means don't just take the client's word for it. If the client or management, if they tell you something in the course of the audit, you don't just say, okay, and move on. Rather, you need to have a questioning mind. You need to evaluate and critically evaluate the evidence that you are given. You need to see if that evidence corresponds and supports what management has told you, whether it corresponds and supports other evidence that you have obtained. Don't just take the client's word for it. We have a responsibility to be thorough, to seek supporting documentation for everything that we do. We need to keep a critical eye over the evidence. There was a really interesting line that I read, I believe it was in your textbooks, but essentially it said, look, the auditor should not assume that management is dishonest. However, the possibility of dishonesty must be considered. So we're not saying that management is definitely lying to us and we shouldn't believe anything that they tell us. It's rather, well, there's a possibility that they can lie to you. They can give you information that is actually not true. So we need to keep that critical eye over the evidence. We need to maintain a questioning mind throughout the audit. Now, this goes hand in hand with the fact that we must exercise professional judgment. There's many areas as part of the audit, and you'll understand this as we go through the audit process. There's many different areas that we really do need to exercise our judgment. Now, why do we call it professional judgment? Remember, we're the expert. We're the independent expert that comes in and checks the information to determine if management are indeed telling the truth to shareholders, whether the information is a true and fair reflection of the company. So it's really important, just to summarize, because the accounting standards do have choice, there is a possibility, and remember we spoke about this as the agency theory, there's a possibility that the financial report can be biased because the people preparing that report can have an interest in, and they can be judged on that report, for example, when it comes to their bonuses. And as a result, keeping all this in mind, we must maintain a questioning mind. We must act with professional skepticism, and we must carry out our audit through the exercise of professional judgment to make sure that we apply our knowledge, we apply our experience, our expertise to ensure we do a good quality audit. We exercise professional competence and due care. That's it for the next video. Well done for keeping track. If you do have any questions, please do let me know. Have a great day.